Today we are joined by Mr. Jacob Mitchell, the Chief Investment Officer and founder of Antipodes. Jacob, as the founder of the company, can you tell us a little bit about your background and the history of the company?
We founded Antipodes in March 2015 as a high conviction manager of global and Asian equities, both long only and long short. We clearly have a focus on capital preservation. Previously, I worked for 14 years at Platinum Asset Management, most recently the Deputy CIO, responsible for just over $3.5 billion of FUM in a direct management sense. And it was for me, Antipodes is just simply the next step in a record of high conviction investing. We've built out a team. Across the team, we have over 100 years of experience in global equities investing. And we are also partnering with Pinnacle, primarily as the provider of our infrastructure and our distribution support, and that allows the investment team to really focus on investing. And we launched our funds in 1 July 2015 and we're very sort of enthusiastic in terms of how we manage the business, and we see the benefits of creating a structure of very tight alignment between investors and the investment team.
How is your investment team aligned with investors?
We've decided to offer products with performance fees to put a fair amount of the firm's compensation at risk, in the sense that if the investment team doesn't produce performance, then ultimately there will be a fairly small bonus pool. If the investment team is successful, and we look at this over the medium to long term, so 3 to 5 years, then there is that great outcome for investors and the investment team, and I think that's the best way of creating a simple, transparent alignment.
What are the investment objectives of the fund, and what is your investable universe?
The objective of the fund is to deliver absolute returns in a risk-adjusted sense over the investment cycle, 3 to 5 years, and to do it in a high conviction capital preservation approach. In terms of the benchmark, we do measure against a benchmark as a way to calculate our performance fee, but we are really benchmark unaware investors. The benchmark for the global funds is the MSCI All Countries World Index, but we are in no way constrained by that index. We can invest in developed markets, emerging markets, and really our universe of opportunities are in large capitalization companies. So companies we're targeting, typically companies greater than $2 billion market cap. And in that sense, there's over 4,000 companies that are larger than $2 billion market cap. So there's a vast opportunity set for us to take advantage of.
Can you talk through the investment philosophy behind your strategy?
We see investment returns as a function of the business, the quality, the resilience of the business you're buying. And that is ultimately measured by the sustainability of its competitive advantage. And then it's a function of what you pay for that business. So that is our definition of return. Our definition of risk is a combination of stock level risk. So we control that by buying businesses cheaply. Margin of safety protects you from that permanent loss of capital, which is what real stock level risk is all about. But it's more than just resilient businesses, it's resilient investments. And that's the concept of multiple ways of winning. So your investment case cannot be dependent on just one single factor outcome. The second aspect of risk is going beyond stocks. It is the behaviour of the overall portfolio. So when we're looking for opportunities, as a high conviction manager, we're only looking for 30 to 50 stocks in a universe of 4,000 companies. That means we can be very selective and we can build portfolios with non-correlated sources of alpha. So the next question is, why should you be able to buy those selective stocks at a discount to intrinsic value? And we think that happens because markets can tend to be irrational around changes in the environment that are impacting businesses. Those changes that we see typically fall into three buckets. They're either cyclical, structural, or they're broad socio-macroeconomic changes. It's when markets become irrational that you get the opportunity to buy the company, a great business, at a great price.
Your investment approach talks about the market's tendency for irrational extrapolation. What does this actually mean for investors?
The concept of resilience or sustainable competitive advantage must be subjected to ongoing tests, because the problem with really resilient businesses that are highly profitable is they attract competition. And in a cyclical framework, that typically means capacity or new competition leading to capacity expansion in an industry, and then when there's a small change in demand, that's enough to tip the industry into the shakeout phase. In a structural sense, it is a strong incumbent that becomes quite lazy, starts to feed off its profit pool, profiteer, and opens up a price umbrella for new competition. In both situations, it's really about challenges that are facing the business, whether they are technological or competitive or regulatory or simply management missteps. And that is what typically allows us, and only with a disciplined fundamental approach can you determine whether the impacts are permanent or temporary. But it's that's what we describe as irrational extrapolation around those factors that opens up an opportunity to buy a business, a great business at a great price. That's what we mean by irrational extrapolation. And we bucket that as cyclical, structural, and socio-macroeconomic. And it's ultimately a continuum. All three factors impact businesses at all points in time.
In terms of process, how do you select stocks for the portfolio?
Best way to describe it is an eclectic approach. It's a combination of the qualitative experience of the team and pretty heavy use of quantitative tools. In our experience, the combination of both is very powerful. We also manage the team as a scarce resource. We're ultimately a performance-based research organisation. So before we go too deep into a project, we like to use the quant experience is very good for getting a broad perspective before we go too deep. And also we use a buddy system whereby each lead analyst on a project also has a buddy assigned. And the role of the buddy and the role of the investment team before we go too deep is to act as a sounding board for the promoter of the idea to provide a reality check. And the reality check is around a common sense test of the likelihood of a margin of safety, multiple ways of winning, and the likely diversified nature of the alpha outcome relative to what we already own. So the existing portfolio informs the investment process. We won't research ideas that we already believe we are fully exposed to within the portfolio. We can be selective, we can work on something that does have a non-correlated alpha profile.
Please describe how you integrate your considerations of environmental, social and governance issues in your investment process.
Consideration of environment, social and governance factors is done as a part of the deep dive research process. We see it as ultimately a way that we measure the performance of management. And in our investments, we're looking for a minimum acceptable level of performance. And then ultimately, to the extent that companies that we have invested in do start to fail in this area, on a case-by-case assessment, we may choose to actually divest the company. So it is seen as an important part of controlling risk around management behaviour, is simply the study of the track record. The track record is the best indicator of future performance by management in this area.
You manage a concentrated portfolio. How do you manage this risk?
So we manage concentration risk through two principles: minimum level of diversification, and secondly, diversified sources of alpha. So what does that mean? For us, the minimum level of diversification is 30 to 50 stocks. Why? Because beyond 30 stocks, you get most of the random benefits of diversification from a protection from unknown risks, the risks that you can't control. That gives you most of those benefits. Diversified sources of alpha is a little bit more of a qualitative assessment of risk, where we believe we can control and measure build-ups of similarity in the portfolio, and making sure that the portfolio will behave in a way where if there is a shock, maybe it's a certain outcome tail risk event, we know where the concentrations of risk are, and we have diversified our alpha source sufficiently to protect against those sorts of outcomes.
Your strategy can have a broad allocation across the globe. How do you manage currency risk within the portfolio?
So we see currency as another risk that we need to manage. So when we buy a stock, we also buy a currency. As a part of our consideration of socio-macroeconomic factors, we consider that currency risk. And if based on our fundamental valuation models of currencies, if we believe the currency is significantly overvalued, and we do apply a higher margin of safety in that assessment because of the unknown risk around anything that is macro in its assessment, we will hedge out of that currency into a currency that we feel is more attractive as an evaluation sense. That is ultimately a strategic view, and so our currency views are very high conviction in that sense.
Being a global equity strategy, how do you determine the geographical disposition of the portfolio?
As a index unaware manager, we simply invest where we see opportunities. So we're looking for, those high conviction ideas, regardless of where they're located. And ultimately, the goal is to build those portfolios in a non-correlated alpha outcome. So that will, in a sense, put a certain limit on how much exposure we will have to any one region or sector, but we're not constrained by the benchmark.
In the Global Long Only Fund, what is your typical net invested position?
The typical range is 75 to 100% invested. That means we can hold up to 25% cash. The decisions around holding cash are really done relative to our opportunities, and to the extent that we can't find individual companies that meet our investment criteria, we will hold cash.
In your Global Long Only Fund, what sort of investor does the strategy suit, and what is the recommended time frame for investment?
So the fund will suit an investor that is seeking exposure to global equities in a high conviction approach, where the return profile of the fund is very much over the investment cycle. So 3 to 5 years, and the other benefit of that clearly is gaining exposure to industries that are not available in the local Australian stock market, and diversification away from Australian assets. On top of the benefits, those generic benefits, there is the specific mandate flexibility around currency. So we can own stocks, but we can also manage the currency risks around those stocks.